Joseph Carlson is an investor as well as a content creator, and he regularly discusses his investing strategy, his outlook on the market, and how well his portfolio is performing. Now, in 2023, he outperformed the S&P 500, and in today's episode, we're going to look at 6 of his dividend stocks to see whether or not they are undervalued. We're going to look at their historical performance. We're going to take a look at their dividend safety, looking at the supporting financial metrics. And as always, we will run them through our valuation model, getting to the intrinsic value, as well as our acceptable buy price given our investor margin of safety. And we'll take a look to see what Wall Street are forecasting for each of these stocks over the next 12 months. So let's jump into the dividend stock number 1. We have S&P Global, ticker symbol SPGI. Now, 2023, they had a positive year, near enough in line with the S&P 500, up around 27%. We can see they are trading towards the mid to upper end of the 52-week range, with a forward yield of around 0.84% and a forward P of 34. Now, if you've been holding this company over the last 10 years, you would have a pretty strong return, up around 448%, although bear in mind this doesn't include those dividends reinvested, and we can see its all-time highs towards the beginning of 2022 and the end of 2021 at around $470. So in terms of dividend safety, it is very safe. The highest score obtainable, 99, market cap 136 billion, a mega cap company. Now, in terms of those who believe a recession is coming soon, well, they increased their dividend during the last recession in 07-09. They had below average growth of negative 38%. Bear in mind the average growth of companies in the S&P 500 during 07-09 was around negative 12%. Now, January 2023, they increased the dividend by 5.9%, which means that this month they should be having another increase. Now, it is above the 4% that I advocate on the channel to keep up in line with inflation, but slightly disappointing when you consider the double digits on average over the last 5 years, as well as double digits over the last 20 years. So it'll be interesting to see how 2024's dividend compares. They are also 1 year away from becoming a dividend king, so if they increase that dividend this month, which is very much expected, they will obtain dividend king status. Now, in terms of dividend yield theory, it states that the company is undervalued when the current yield sits above the 5-year average. So we have a sign here of reasonable valuation. It isn't too far off the 5-year average of 0.9%. Although do bear in mind we don't look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. Forward P, however, is slightly higher at 30.8 than the 5-year average of 28.7, and when we compare it to the financial sector P of 11.3, S&P Global does sit considerably higher. So let's take a look at the free cash flow payout. Now, for those viewers who are new, we do ignore the earnings. It is susceptible to manipulation by management through accounting. One example we can give right now, in 2015, if you were to focus on the earnings, 29% you would be fairly happy. However, we can see in 2015 they paid more in dividends than they generated in free cash flow. Now, that is a red flag, but as we can see, that was a long time ago, and since then it has been below that 60% target that I look for as a maximum, because I believe it is below 60%, management have that ability to offer those double-digit increases. And 2023, when the annual report comes out, it is expected the free cash flow payout to be 34%, so that is positive to see, and we should be expecting a nice dividend increase this month. Free cash flow per share, 158 in 2013, 793 in 2022. We can see it has increased over the last 10 years. It is again expected to increase in 2023 when that report does come, but you can see the inconsistencies as it has been at a much higher rate in 2021. Sales growth, 3 to 7% is what we aim for steady, moderate growth. What we can see, though, they have had double digits increase to the top line since 2020, with 2023 expected a strong 19%. So that is very positive. It is a fast-growing company over the more recent period, and numerically, it has nearly tripled its top line, 4.7 billion in 2013, 11.2 in 2022. Now, we love companies that do share buybacks, returning excess cash to investor pockets. And what we can note here from 2013 to 2021, this is something that S&P Global did, but they did acquire a firm, and that is why we do see this increase to the shares outstanding. If you're interested to hear more details about that, do check our specific deep dive to S&P Global that we have performed on the channel. ROIC, again, we can see some strong double digits year on year from 2013 to 2021. I personally look for 10% or more. It gives me faith that management are able to effectively allocate their capital. And as we mentioned with that essential acquisition, we can see it did drop down to 7%, but we should be expecting some very high double-digit numbers from S&P Global moving forwards. Operating margin and free cash flow margin, very, very positive to see, well above the 12%. In fact, 2023 expected 35%, and that is positive. Likewise, the same on the free cash flow margin, 27% in 2023, a free cash flow machine. Now, finally, the last metric, the net debt to earnings before interest, tax, depreciation, amortization, shows us two things: dividend safety as well as balance sheet strength. These numbers show us the maximum number of years that it would take the company to pay off all of their debt net of cash on hand. 2023 expected 1.81. It is significantly lower than 3, so we can see why that dividend remains to be safe, and they do, based off this, have a strong balance sheet. So let's jump into the valuation model, and as always, if you enjoy this type of content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So typically on the channel, we run through Graham's valuation, the multiples, the dividend discount, the discounted cash flow to get to our intrinsic value. For today's episode, we'll go straight to the final part, and the intrinsic value for S&P Global in today's episode is just the average of these three models. Now, $459.81 with the current price of $427. We typically start off with a margin of safety of 10%. This is if we believe it essentially meets three criteria: if it has a wide moat, strong financial metrics, and good forward-looking data. We can see right now we don't believe it to have a 10% margin of safety. For that to hit, it would need to be around $414. At 5%, we can see it is a buy. However, that really does come down to the margin of safety. So right now, we do believe SPGI has around 5 to 10% margin of safety. In terms of Wall Street and what they believe, well, they see around 10% upside over the next 12 months. So in conclusion, for the first dividend stock, S&P Global, we see around 5 to 10% margin of safety, with Wall Street expecting 5 to 10% upside over the 12-month period. Moving on to dividend stock number 2, we have VICI Properties, the real estate investment trust. Now, 2023 again wasn't a great year for them, pretty much flat. We can see they are trading in the midpoint of the 52-week range. They offer a yield of 5.24% and a forward P to FFO of 13.22. So if you've been holding this over the last 10 years, you can see it has been pretty strong from around $18, essentially up around 60 to 70%, and over the last 5 years up around 66%. So let's take a look at the metrics. 50 borderline safe for the dividend safety, which we'll touch upon shortly. 33 billion market cap, a large cap company. Now, their company was essentially founded after the recession, so we do have no recession data. So we jump straight into the dividend growth, the latest increase at 6.4% in September last year. Nice because two things. Well, one, you do lock in a very nice yield of over 5%, and two, it is increasing above the rate of inflation, so that is positive to see, and they have been increasing that dividend for the last 4 years. So let's take a look at dividend yield theory. We can see 5.24% versus the 5-year average of 5.03. So you could argue some signs of undervaluation here. Forward P to FFO ratio 14.3, near enough the 5-year average of 14.8. And when we compare it to the real estate sector, we can see VICI Properties is pretty much in line. So when we take a look at the free cash flow payout, one thing to note for REITs, because they are more volatile, we do focus on the adjusted funds from operations, 75% or lower for hotel REITs, and we can see for VICI Properties it has been pretty much straddling along that line. 2023 and 2024 expected to be pretty much the same. Now taking a look at the adjusted funds from operations per share, 37 cents in 2017, 193 in 2022, expected to go higher in 23 and 24. So it is nice to see those consistent increases year on year for VICI. Now we look at the sales growth, we can see for REITs we tend to look for 5 to 10%. The last 3 years, as well as 2023 expected, are looking very, very strong double-digit increases to the top line. And numerically speaking, we can see from 2017, 200 million to the top line to 2.66 in 2022, expected 23 when their annual report is delivered, 3.47 billion. And as always, if you do want to be up to date with all the latest annual reports, quarterly earnings, do hit that subscribe and bell button so you don't miss anything. Shares outstanding, this is very typical with REITs. They do dilute your position, some faster than others. If you have seen our reviews on REITs, you will see which ones do dilute your position quicker. 228 million in 2017, 880 in 2022. And the reason for this is because they essentially depend on issuing equity to fund their property acquisitions. As we noted earlier, they don't retain a lot of that internally generated cash flow after paying those dividends. ROIC for REITs, we tend to bring it down to around 3 to 5%. Positive to note, 2022 at 5%, 2023 at 8% expected. Operating margin as well, very nice to see, very high, a minimum 63%. 2023 is expected a very strong 91%. So let's take a look at the net debt to EBITDA, and we can understand why that dividend safety above says borderline safe. 6.46 in 2022, it is above that 3.5 we would like to see for hotel REITs. 2023 expected to come down lower, which is a positive sign. 2024 expected to come down even lower to 5.58, so they are moving in the right direction, which is always positive when analysing. As always, do click on that pinned comment below if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. So margin of safety, we start off with 10% for VICI properties. It is a buy up to $33.90 based on our estimates and judgments. And at 15%, it is near enough the current trading price at around $32. In terms of what Wall Street forecasts, well, they do see the share price to go up to around $35 over the next 12-month period. So in conclusion, for VICI properties, we see around 15% margin of safety with 15% upside from Wall Street forecasts. Moving on to the third company, we have Intuit, ticker symbol INTU. Now 2023, very strong, up 57%, a fantastic year for the company and shareholders alike. Towards the mid to upper end of the 52-week range, we see the yield at 0.61% with a forward yield of just under 36. Now, if you've been holding this over the last 10 years, phenomenal, up 673%, and we see its all-time high just under $700 at the back end of 2021. Dividend safety, 98, very safe, 165 billion market cap, a mega cap company. Recessionary metrics, well, they didn't pay a dividend during the last recession, plus 1% sales and outperformed the S&P with a negative 29% return versus the S&P's negative 55. Dividend growth, what more can you ask for? Double-digit increase last year at 15%, 15% again in over the last 5 years on average, and 16% on average over the last 10 years. Absolutely phenomenal, and they have been increasing those dividends for the last 11 years. Now, dividend yield theory, as we can see, reasonable valuation / some slight overvaluation, 0.61% versus 0.7%, and we can see the forward PE pretty much in line with the 5-year average. And when you compare it to the information technology sector PE at 23.7, Intuit does sit significantly higher. So let's take a look at the free cash flow payout. No surprises here given how low that yield is, but it has been in fact below 40% over the last 10 years, 2023 coming in at 18%. So we should be expecting, again, high double-digit increases to the dividend this year. Free cash flow per share as well, one of the most consistent companies, 442 in 2014, 17 in 2023. Nearly every single year, nice consistent increases, and 2024 expected to be more of the same, around $20 per share. Sales growth, double digits every single year, pretty much other than 2015 where it was negative and 2014 which was still very strong. So it is nice to see it is a fast growing company, and that is shown here by those sales going from 4 billion to 14 billion in 2023. Shares outstanding, they've done share buybacks, they've also issued shares, but over the position, the net position in fact has been share buybacks by around 8 million. So that is positive to see when you consider those very strong dividend increases. ROIC then, well, above 10% every single year, so that makes me happy. And we can see 2023 at 13%, so no real worries in my opinion around management and their ability. Operating margin, free cash flow margin, I mean just purely on that free cash flow, they are a machine. Nearly 30% on average over the last 10 years, and the operating margin looks very healthy as well. So finally, the net debt to EBITDA, I do love seeing this when it is very low. It does show a very strong balance sheet as well as a dividend safety. 0.47 years in 2023, so very, very strong. So let's take a look at the valuation of INTU. And as always, if you enjoy the content, smash that like button, hit the subscribe and bell button, and do let me know whether you are liking this type of content. So the intrinsic value sits fairly high at $734 with a current price of $586. 10% margin of safety, a buy up to $660, 15% up to $623, and at 20% pretty much bang on the current trading value. So in conclusion, for Intuit, based on our estimates and judgments, we see a 20% margin of safety. Now, in terms of Wall Street, we can see they forecast around $700 upside over the next 12 months, showing around 20% upside. So in conclusion, 20% margin of safety, 20% upside. So this does seem to be the most undervalued dividend stock currently from those that we have just run through. Moving on to stock number 4, we have Texas Roadhouse. Again, fairly positive 2023, at least in line with the S&P 500, and again towards the upper end of the 52-week range. 1.86% forward yield, and we see a forward P of 26. Now, if you've been holding this over the last 10 years, very positive, up 343%. Dividend safety 80, it looks to be safe. 8 billion market cap, a mid-cap company, and we can see they didn't pay a dividend during the last recession. However, they had positive recession sales and also outperforming the S&P 500 with a negative 33% return. I mean, this is even better than Intuit, which I thought was phenomenal. 20% increase last year. We are expecting another increase next month. 17% over the last 5 years, 18% over the last 10 years. They are growing their dividend at a very fast rate, but do note they have only been increasing their dividends for the last 2 years. As we can see from this graph, in 2019, in that COVID year, they did cut their dividend, but they have been restoring it at a very quick rate. So dividend yield theory, what does it show us? We can see reasonable valuation / slight overvaluation, 1.86 versus 2.01, and the forward PE isn't too far off the 5-year average of 22.2. Now, consumer discretionary sector P, however, is significantly lower at 14.4. So looking at the free cash flow payout, it shouldn't come as any surprise with those very high dividend increases. 2022 at 47%, 2023 expected to go higher at 74%. So something just to keep an eye on. It wouldn't be a surprise to me if they do not increase the dividend as high as they did last year, but still at a fairly decent rate given that increase in the free cash flow payout. 89 cents then, free cash flow per share in 2013, 3.93 in 2022, but again we do see a drop expected in 2023. Sales growth then, double digits nearly every single year bar COVID, which is completely justified in my opinion, so very, very strong. I love the consistency. It is increasing at a very strong rate. Now, when we look at that numerically, 1.42 billion to the top line to 4 billion and 4.5 expected last year. Shares outstanding on top of all that positive information, they do share buybacks, 71.4 million in 2013, 68 in 2022. ROIC as well, very positive. Again, that justified COVID drop, but 2021, 22 and expected 23 at 18% is absolutely phenomenal. Free cash flow margin, operating margin leaves something to be desired, but again, this is fairly typical of restaurants that they do have lower operating margins. Just something to keep an eye on though. If consumers do essentially get squeezed and they don't tend to go out as often as they used to, if we do enter a recession, then this may be one where they may start lowering prices to attract more customers and it could hit their operating margins, but just something to keep an eye on. Not necessarily saying it'll happen, but as always, do think of a lot of scenarios. Free cash flow margin then, not too bad. It does straddle around that 5%. Now, net debt to EBITDA, very positive, 1.1 in 2022, 1.23 expected in 2023. So, very positive in my opinion, based on the information that we can see right now. So, let's jump into the valuation. And the intrinsic value for Texas Roadhouse today is the average of these three models, coming to around $130. Now, margin of safety, as always, we'll start with 10%, and we can see it is pretty much around that current value. So we do believe it has around a 10% margin of safety currently on the market price. In terms of Wall Street and what they forecast, well, we can see that they only really believe there to be around 5% upside over the next 12 months. So in conclusion, around 10% margin of safety, but really only 5% upside per what Wall Street are forecasting over the next 12-month period. We now jump into dividend stock number 5. We have Mastercard Incorporated, ticker symbol MA. Now 2023 up 19%. We do see them up towards the mid to upper end of the 52-week range. A yield of 0.63%, forward PE of 34.5, and over the last 10 years you'd be up a very, very strong 402%. So dividend safety 99, the highest score obtainable, 393 billion mega cap company. And recessionary metrics, well, they maintained the dividend. They didn't cut it, but they also didn't increase it. Plus 2% sales, above average growth, and significantly outperformed the S&P with a negative 12% return. Dividend growth, I mean, today we're just talking about very strong dividend growth companies. 16% increase just a few weeks ago, 18% on average over the last 5 years, 33% over the last 10 years, and they've been increasing this dividend for the last 11. So lots of positives for a dividend growth investor. Now, dividend yield theory, we have a sign of undervaluation, 0.63 versus 0.54, as well as that forward PE at 30.7 versus 33.3. Now, sector PE sitting at 11.3 for the financials, so Mastercard is sitting significantly higher, but I do believe that it is a premium company and that is extremely justified. Free cash flow per share, well, pretty much below 20%, in fact, nearly every year. 22 expected in 2023, so I would be expecting this year another very strong double-digit increase. Free cash flow per share, well, $3.17 in 2013, $10.40 in 2022. Very strong increases, in fact, 3 times over the last 10 years. And we will see that 2023 does seem to be fairly flat, so something just to note, although 2024 is expected to go higher. Sales growth, again, double digits nearly every single year. We have that COVID year with negative growth. 2023, however, at 13% is a very strong sign. And when we look at it numerically, it has, in fact, nearly 3 times their sales over the last 10 years. 8.3 billion to 22 billion and 24 expected in 2023. On top of all of that, they do share buybacks, returning excess cash to investors, 1.2 billion in 2013, 971 in 2022. So there is a lot to love with this company. And if you want some more positive financial metrics, ROIC, phenomenal, 59% in 2022, 63% in 2023. Free cash flow margin, operating margin, not sure there is anything really to say, but just take this in. This is an absolutely phenomenal company. And these are the sort of metrics that we would also see when we would analyze Visa. Now, taking a look at the net debt to EBITDA, we can see again, it wouldn't take them many days to pay off all of that cash, or all of that debt, in fact, net of cash on hand. So let's look at the valuation. Don't forget you can click on that pinned comment below, grab a copy of the valuation model, run your own numbers through for your own companies in your own portfolio, and get your own acceptable buy price based on your own individual investor margin of safety. So let's start off for Mastercard at a 10% margin of safety, and we can see it isn't too far off the current trading value. So we see around 10% margin of safety. Wall Street, we can see again, they expect around 10% upside over the next 12 months. So in conclusion, for Mastercard, we see around a 10% margin of safety with around 10% upside over the next 12-month period per what Wall Street are forecasting. Moving on to stock number 6, we have Union Pacific Corporation, ticker symbol UNP. 2023 up 18%, fairly positive, and we can see they are trading towards the upper end of the 52-week range. Current yield at 2.17% with a forward PE of 23. Now, if you've been holding this company over the last 10 years, you would be up around 182%, and we can see their all-time high towards the beginning of 2022 at around $273. So dividend safety, 88, very safe. Market cap, 146 billion. Mega cap company. Last recession, how did they perform? Well, increased the dividends during the 07-09 recession. Below average growth of negative 21%, and they beat the S&P with a negative 42% return. Now, they haven't increased that dividend since May 2022, but over the last 5 years on average, it's gone up by 15%, and over the last 20 years by around 17%. Dividend yield theory, then, we can see it is showing reasonable valuation. The current yield in line with the 5-year average at 2.17, and the forward PE, however, slightly higher at 21.8 versus the 5-year average of 19.4. Now, when we compare it to the sector PE, industrials is slightly lower at 19.4. So let's take a look at the free cash flow payout. We can see in 2022 at 55%, 2023 expected to go slightly higher at 67%. So it is still around that 60% that I do look for. So right now this is looking fairly positive. Taking a look at the free cash flow per share, well, they have nearly 3 times it over the last 10 years, 359 in 2013, 922 in 2022, although it is expected to drop once that 2023 annual report comes out. And don't forget to subscribe, hit that bell button, because I will be releasing videos when these quarterly earnings do come out to analyze them. So let's take a look at sales growth. Well, you could argue the cyclicality of the industry. We see positive growth followed by negative growth, and this seems to be the case year on year. So numerically, how does that look? Well, 22 billion in 2013, 25 billion in 2022. So this isn't a company that's going to continually grow their top line at a very fast rate. Just bear that in mind. It doesn't mean it's a bad company to invest in, but different industries will have different things you do need to know as an investor. Shares outstanding, though, this is absolutely lovely. 932 million shares outstanding in 2013, 624 in 2022. So they are returning a lot of that excess cash to your pockets. ROIC consistently above 10%, very nice, 16% over the last 2 years, 15% expected in 2023. Free cash flow margin, operating margin, this is one thing I do love about this company as an investor myself. Very consistent high margins on both the operating as well as the free cash flow. Now, net debt to EBITDA, something just to keep an eye on. It has been increasing over the last 10 years, 2.87 expected in 2023, although they are expecting to bring this down in 2024. But just something that you should be analyzing or taking a look at, and something that I am too as an investor, as you don't want this to go too high, especially the way it has been increasing over the last few years. So Union Pacific, let's jump into the intrinsic value. And don't forget, if you are enjoying the video, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Current price then at 240 with an intrinsic value of 252. We see at 10%, it isn't a buy until 227. So right now when we do take a look, it is pretty much bang on a 5% margin of safety. And in terms of Wall Street, they also expect around 5% upside over the next 12 months to around $250. So this is probably the one out of all 6 that is least undervalued, with a very minimal margin of safety, as well as upside predicted by Wall Street. As always though, do let me know your thoughts in the comments below. Are you adding any of these? Are you a shareholder of these? Or are there some that you might be putting on your watch list now? Don't forget, click on that pinned comment, grab a copy of the valuation model, run your own companies through the intrinsic value calculator, getting to your own acceptable buy price, whether that's companies in your own portfolio or your watch list. As always, have a great day, catch you on the next episode, and take care.